Hello, this is the Ultimate Access 10-minute video series preparing for the CIMA exam operational case study February 2018 based on the pre-seen King Crystal. My name is Sandy Hood and there's a picture of me in the summer. We're looking at F1 syllabus topic B part 2, which is to produce the primary financial statements of an individual entity incorporating accounting transactions and adjustments in accordance with relevant international financial reporting standards in an ethical manner. And we're looking at part B within part 2, which is to apply the rules contained in IFRS, International Financial Reporting Standards, to generate appropriate accounting entries in respect of, in this case, accounting for taxation. Now, the background knowledge from F1 is that we need to know about accounting profit, and we need to know about taxable profit, or what is sometimes referred to in the syllabus as taxation profit. IAS 12 defines accounting profit as the profit or loss for a period before deducting tax expense. So it's our profit before tax figure, basically. And it's consistent with the definition of taxable profit in so much as that is also a calculation of a profit before the tax has been deducted. Only here the taxable profit is calculated according to the rules established by the taxation authority in the country that we're dealing with. So in our case it would be Gigland. Now, from the King Crystal pre-scene on the final page, we get the Gigland Tax Authority information, which tells us about corporate tax rate being 30%, and it gives us the other accounting rules and so on that are applied, so that we're able to identify the difference really between the accounting profit and the taxation profit. And here we are given a list of those expenses that might be allowed within an accounting profit calculation, but not in Gigland anyway, in the way that we would calculate a taxation profit. We've also got a little bit here on taxation or tax depreciation allowances, what some of us in the UK would refer to as capital allowances, and also the way that Gigland treats government grants, and the way that certainly these grants are treated as far as a tax angle is concerned. So here's a little bit of information about King Crystal, and we can see from here that in 2017 their tax has been calculated as 28.4%, whereas in 2016 it was 29%, which are interesting because we can know that those figures are obviously tax divided by the accounting profit. It gives us an idea that the taxation profit must have been different in order for us to be able to have something other than 30%. And so here we've got the statement of financial position, and we can see certain things as far as tax is concerned. We can see that we've got some tax payable, and that's shown here with a big black arrow, and that's been estimated for 2017 as being 210,000 Gigland dollars. We can also see that there's nothing in the non-current liabilities section, so there's no deferred tax. Interesting, because there is an allowance for deferred tax, but in this case King Crystal doesn't have any. A little bit more from the syllabus, we can see that as far as F1 syllabus D part 3, we have to produce computations for corporate tax, corporate income tax and capital tax. So we've got these other different pieces of information which are general, which are not specific to the King Crystal. They are within the syllabus for all of F1 exams. Here's a question that Paul Aldo has asked you. We made a profit of 704,000 in 2017, but he knows that corporate tax rate is 30%, and he borrowed his daughter's calculator, which is very kind of her, and he found that 30% of 704,000 would have been 211,200. And then he asks you the question as finance officer, why does our statement of profit or loss state that our tax on 704 gigland dollars is only 200,000? So there's an implicit question here is, are we falling foul of the tax rules? Are we evading tax in some way? So here you must answer the question. You need to understand the pre-scene, and you don't need to remember the numbers. So why does our statement of profit or loss state that our tax is such and such? Well, you have to plan your answer, and I would say that you plan it. Can you see? I've given you a layout. This is exactly what you would see in your exam. You plan it in that document. This is exactly what your examiner is encouraging you to do as well. So here I've entered these various bits of information, the tax calculation timing, the difference between accounting profit and taxation profit, these disallowed expenditure items, the implication of tax depreciation allowances, implication of government grants. And then after the plan, you go back and you check to make sure that you are really answering the task. And the task was, why does the statement of profit or loss state that our tax is only 200,000 and not 211,400? So we listed the reasons for the differences. So it looks as if our plan is matching what the task requires, so we get a tick. So here we then start to insert the rows into our answer so that we're able to demonstrate our knowledge. And we now start to fill in the detail. Can you see these short paragraphs? We calculate our tax after we've worked out the profit we made for the year. We modify the profit figure that we produce to a different value. So we're going from an accounting profit to a taxation profit to produce a different value based on the Gigland Tax Authority rules. Our tax calculation is an estimate. All these little words are getting us marks. An estimate. So the tax authority will review it and they can agree it, but there is very often a difference between their figure and our own. Last year, we estimated that our tax bill would be 164,000. When they had carried out their sums, meaning the tax authority, Gigland Tax Authority said that we only had to pay 154,000. We over-provided for tax. This meant we could reduce the tax expense this year by 10,000. Okay. So we're helping Aldo to understand. Next we come to the tax current liability. The estimated tax for the year is shown as a current liability of 210,000. The statement of profit and loss is 10,000 lower due to our over-provision from last year. So here we are, we're recognising these bits of information that are given to us. We don't necessarily have to get the numbers, but we have to show the examiner that they will understand why they're different. Then we talk about the difference between the two, the accounting profit and taxation profit. Then we can introduce the disallowed expenditure. Now it's interesting here, and I'll show you that here we've got excluding the disallowed, it makes the taxation profit higher. But there are other adjustments which would bring the taxation profit lower. So in our case, always relating back to the scenario, we are showing that we understand what's going on, so there must have been a lower taxation profit than the accounting profit. Then I've got a series of headings, and you'll notice that I haven't actually taken them any further. And then I've gone on to tax depreciation allowances and explained that these aren't being taken into account because there's no deferred tax shown on the financial statements. Similarly, no government grant is shown. So I hope that you've found this useful. And thank you